So let's move on and check out monetary policy. Let's get a few more details about monetary policy. This is a little bit of a review from money and capital markets and from macroeconomics. Okay? The top priority of the Federal Reserve Board is to maintain price stability in the economy. What does that mean? Keep inflation low and stable. Okay? Their second priority is to maintain full employment. Keep unemployment low. We want to keep people working. Therefore, the Fed must design and implement monetary policy to maintain a balance in the economy between inflation and employment, otherwise known as the Phillips curve, the trade-off between inflation and employment. And so the Federal Reserve will meet every 6 weeks. The Board of Governors will meet every 6 weeks to review economic data and economic trends and to discuss their views as to where they think the economy is headed. And then they decide whether to tighten, ease, or remain neutral with their monetary policy and the money supply. What are they going to do with the money supply based on how the tea leaves that they're reading, the economic data that they're interpreting about the economy. So there are 3 tools that the Fed uses to implement policy. The main one is open market operations. What is this? Well, to ease or grow the money supply, the Fed will buy bonds from the primary dealers. They will buy bonds from the banks. Let's take a look at the primary dealers. These are 35 banks and investment banks. This gives the banks additional money. If the Fed is buying bonds from the banks, they are injecting money into the system. As the supply of money in the banking system grows, but the demand for the money stays about the same, the effect is to reduce the price of renting the money, and that price of renting the money is the interest rate. So money supply grows, demand does not immediately grow, and so interest rates come down, which then causes demand to go up. Okay? Please note that just because banks have more dollars to loan does not mean necessarily that they will lend it. It really depends on the regulatory environment. Will the regulators, are they pressuring the banks? So the Federal Reserve can be injecting money into the system, but the Treasury and other agencies in the federal government could be putting the squeeze on banks and telling them to cut back on their lending. So those agencies, the Federal Reserve and those regulatory agencies, need to work together to get to have the effect on lending that the Federal Reserve wants to have. If businesses, and also just because interest rates go down, it doesn't mean businesses will borrow. If businesses don't have enough confidence to expand, or if regulators don't back off the banks, lending will not increase. And so we saw this in 2009 for a while. The money supply grew at the banks, but the banks did not loan the money. In part because the banks didn't want to loan, and in part because businesses were scared they weren't borrowing. All right. To tighten or slow money growth, the Fed will sell bonds to the primary dealers. So they go to the primary dealers and they say, you must buy bonds from us. The banks must buy those bonds, and they expend cash to buy bonds, and that takes money out of the system. Okay, so that's how they shrink the money supply, and this reduces the supply of money. Well, what's going on now? The Federal Reserve is selling bonds back to the bank and taking money out of the system. That's what's happening. Back in 2009, the banks were buying bonds from the primary dealers left and right. They were injecting money in, and now they are reversing that. If the supply of money goes down and the demand for money stays the same, the rent or the interest rate on money will go up. All right, so that's the first tool, the first and major tool that the Federal Reserve has, which is the open market operations, okay? Buying and selling bonds in the market. Second, they have reserve requirements, okay? The Fed determines how much banks' cash must keep on hand relative to how much they lend. The Federal Reserve tells banks how much they have to keep in their vaults and in their system. Okay? The lower the reserve requirement, the more banks can lend, which lowers interest rates. Lowering reserve requirements enables banks to loan more and hold back less, and that causes interest rates to go down. The higher the reserve requirement, the less banks can lend, which raises interest rates. So what is the Fed telling these banks in terms of how much they have to hold in reserve? Okay. Lastly, federal funds and the discount rate. The federal funds rate is the rate banks charge each other to lend overnight reserves to meet reserve requirements. So if a bank makes a big loan and cash flows out of the bank, they may need more cash in order to meet their reserve requirements, and they get on the phone, on the computer, and they start calling other banks and saying, can we borrow some money from you so we have enough cash to meet our reserve requirements? Okay? The Fed affects the federal funds rate through the reserve requirements and the open market operations. So the federal funds rate is what one bank charges another bank to loan to them. Okay? The discount rate is what the Fed charges to loan money directly to the bank. So if Bank A does not have enough cash and they cannot find another bank to loan to them, then they go to the Fed. The Fed is called the lender of last resort, and the Fed will loan to them and charge them the discount rate. Okay? So the Fed is the lender of last resort. So I think that's all I want to say about monetary policy. And we're going to move on in the next clip and talk about currency. Talk about exchange markets. Peace. Shalom.